Well, hello. I set out today to publish another MCR accounting quick tip that came to me as a result of doing the quick tip last Monday on the CPP death benefit. And that got me thinking about the number of Canadians who are not part of the CPP program, and I wanted to speak to that. But as I was doing my due diligence on that particular issue, I realized that more properly, this is a much bigger subject than that. So this will not fit into the quick tip format of 4 to 7 minutes. This is going to be a MCR accounting financial literacy publication. So first, I still want to cover my concern that got me on this path. So the people who can opt out of CPP are people who work through limited companies. They are a limited company, and they can choose to only pay themselves through dividends and thereby not be obligated to make the employer and employee CPP payments, and likewise with EI. Both kind of go hand in hand there. And I'm not saying there's anything wrong with that. That is a choice that people make to manage 100% of their affairs themselves or to opt out of the programs. But I'm not always sure that the young people that have been talked into going down this road by, their bookkeeper or the coffee circle they're a part of, fully understand what all they've opted out of here. So I just want to put that on the table. When you are doing this for the purpose of putting more money in your bank account every month, you are opting out of the Canada Pension Plan, fully and completely. A fully indexed pension plan for your future. And at the same time, you are opting out of any income protection that the bigger EI program covers. So what that means is you do not have an index pension to look forward to. You don't have any form of disability protection unless you're buying it privately. You could be buying it privately. You won't be able to participate in either the maternity leave programs or the paternity leave programs. So let's say I'm talking to a young couple just starting a company, they're working it together. Is that really the direction that you would want to go, and cutting yourself off from that? That being said, it's legitimate to do this, and if you do it, just be aware of the consequences down the road. 30, 35, 40 years later, you can't backtrack out of this. And when you run a business like ours, you see all aspects of it. I mean, MCR accounting's been open for going on 13 years now. So we even have people that we've seen start this, and we've seen where that progression has taken them. And then, of course, we have clients that come in, and they're already at the mature end of this cycle. So I'm just saying that by way of suggesting that I've seen that there's reason to be concerned here. Moving on with that, though, the bigger question is you've opened your company, you've limited yourself for one reason or another, and I'm gonna put that out there too. In our business, what we're seeing is far more people are rushing far too quickly to become incorporated for reasons that of their own that don't necessarily make the best financial reasons or the best tax picture reasons. This sometimes can be forced. I mean, in the area we live in, pretty much any small limited company that wants to provide a service to the oil and gas industry, I mean, even if you want to be a contract employee to the oil and gas industry, most of the big players, for whatever reasons of their own, want you to be incorporated. So you may not even have the choice. But I am just putting it out that there's a vast number of incorporated companies which, certainly in my view and MCR's view, should have probably, would have, without argument, been better off to have remained as proprietors. Okay, but you are already incorporated. And now you're getting a lot of input from one side, says, oh, well, it's way less money to pay yourself strictly in terms of dividends and not pay wages. So I want to deal with that first, because that's not really the truth. So there's a principle called the tax integration principles. These principles were strongly reinforced in 2018, and the tax integration principle, well, let's put it this way. Do you remember in our former financial literacy videos when we were addressing the T2200 or the T2125 or the 2040, we were talking about, we made up that imaginary taxpayer, Terry the taxpayer and his wife Teresa. And we were trying to make sure everybody understood that the taxation benefits that one of these other documents provides to people in these special circumstances are not intended to elevate them above Terry and Teresa the taxpayer. They are intended to enable them to recover that same, total liability picture that Terry and Teresa have. That concept that we introduced with Terry and Teresa the taxpayer, that is, in the essence, the tax integration principles. Now, the tax integration principles, as far as they apply to payroll versus dividend payment, is quite simply, as we watch it on the scroll, the intention is that whether you're paying yourself partly as dividends and partly as income, or all as dividends or all as salary, in the end, the total amount of tax paid will come out the same. That's the principle of tax integration, and these integration principles were very much muscled up in 2018. So there may have been things in the past that people were taking advantage of, and maybe they're still taking advantage of, and maybe their bookkeeper is not quite up on what the most current thing is and is still trying to take advantage of something that's happened in the past. But tax integration means that most of those things that formerly we might have looked at playing around with aren't really going to work out for us anymore. Under today's rules, whether you pay yourself solely from dividends or solely from wages, will only make at the most a few $100s difference one way or the other. And the only way you're going to know is to have both scenarios drawn out, either do it yourself or have your tax professional do it for you, and then you can make the comparison. Be aware that the amount of money that you might save making that comparison could easily be more than what the tax professional would charge you for, basically creating two versions of your tax picture. So that's where we wanted to go with that. So the next thing to talk about here is, we are not talking about the bigger dividends when we're talking about this that come as a part of investment income paid out by really large corporations based on profits. However, that does lead us into the basic definition between the two. In general, a dividend is payment against corporate profit. And wages and salaries, on the other hand, are payment against services or work performed. So they are not precisely the same thing. Where it gets confusing is in small scale, private limited companies, like you're a welding company, a one-man welding company, you're a fabricating company, or any of these types. There's you, or maybe you and your spouse, and that's the company. And that's the dividends versus wages that we're actually having a discussion here. And those are dividends that are paid as a result of completing your year end and reconciling what you'll know as your shareholders loan. And when we're doing that, we need to be aware of this. This is an analyst document by a well-known tax analyst, and I want to draw your attention to the highlighter part. In general, when a dividend is being paid out as a reconciliation of the shareholders loan at year end, that money is actually deemed to be wages. In other words, it's going to be reported on a T4 rather than on a T5. Now, there are exceptions to this rule. I'm not saying it's black and white, but this is the rule, and there are exceptions. Now, there could be consequences to, following down the exceptions path when the exceptions don't, apply to you. If for some reason the CRA was to want to take a close look at your account, you would be in a legal, it would be completely legitimate to reassess you then based on the fact, and we have lots of court cases in our file where this has happened, where it ends up being that this shareholder loan reconciliation is supported in court as being wages, in which case you would really, as a taxpayer, be in a very bad position in terms of keeping your payroll accurate. So that brings us to the next thing. One of the reasons why some people like to stay, let's deal with the elephant in the room first. The biggest reason that people are trying to pay themselves through T5s instead of through the T4 path, instead of through wages and salary, the biggest reason is to avoid becoming part of the CPP and EI program. That's why I addressed that at the very beginning of our talk. They may not think of it that way. They may think of it in terms of wanting to keep that money in their pocket, but that's one and the same thing. If you don't pay in to your pension plan, then you are not in your pension plan. And if you don't pay in to your wage protection plan, then you are not in your wage protection plan. You're out there. You're on your own. You're not participating in these plans. Now, I should also point out, for fairness, that if you had some reason why you really wanted to be out of CPP but still wanted to have an index pension, well, there are ways to buy independent index pensions, just as there are ways to buy independent wage protections. But understand this, it's exceedingly unlikely that you're going to buy private packages in the free enterprise market which are going to be anywhere as cost effective as the great Canadian social programs of CPP and EI. Anyway, that being said, it's, again, like I said before, completely legitimate that you would not want to be a part of that. Just be aware that you might not be able to pay yourself these dividends as investments, right, on a T5 vehicle. They still may be deemed to be wages, and they then would still have those same wage consequences. But before we go down there, remember what I talked about in terms of tax integration principles, right? So if there's only you and your corporation, understand that under the current CRA and laws and rules and regulations, you're going to end up paying more or less the same amount of tax either way, which is why I keep coming back to this is really a CPP avoidance thing, because it's not really going to greatly affect your tax picture in the long run because of the tax integration principle. However, let's like take a quick look at the pluses and minuses of both. So if you put yourself on payroll, the first big plus is you don't ever get yourself in a huge tax arrears problem with the government because you're source deducted tax paying, and that can be a really big deal. Like we see everybody in the business sees a lot of small corporations suddenly hit with these massive tax bills that they were ready for. And I'm not going to say it's company destroying, because it might not be, but it's certainly a major setback to get back on even keel when something like that has happened to you. So that's the thing you're protecting yourself from if you do payroll. The other side of that coin, and this is a concern for quite a lot of people, payroll rules are quite strict, and payroll remittance penalties are quite strict. So if you are in payroll, you need to be remitting in timely fashion to avoid paying penalties and interest on your payroll remittance. That being said, if you pay solely by dividends after 1 year, at that in your reassessment, in your tax assessment for that year, providing you made more than $3,000, which, I'm assuming we're talking about people that are making a living here, you will have been assessed by the CRA that because of the way you're paying yourself, you have to pay quarterly installments now on your taxes. Now here's the thing. The policing of payroll remittance is almost instantaneous, and many people have already experienced that. The policing of quarterly remittance is somewhat less, but the obligation is exactly the same. And if it should come around to coming to the attention of the CRA, it would not just be this quarter or last quarter, it would be all the way back to when you were told you were supposed to be paying quarterly remittances anyway. And then you would be charged penalties and interest just as if it was on payroll all the way forward. So I want to put that out there. I understand all the people that want to tell me now, oh, I've been doing this way forever and nobody's ever caught. I get it. The policing isn't all that strict. But can we talk about that for a minute? Because it's starting to bother me as a Canadian citizen and taxpayer how many people throw that back at me. That if they didn't catch me, that's not my problem. You know why so many things are not strictly policed? In Canada, we believe in the principles of, as voters and taxpayers, I mean by we believe in the principles of self-assessed taxation. So that's been the Canadian tax principle forever. And because of that, our tax system was not set up to be policing in nature, right? So the idea was that there would be a due diligence thing on the part of the tax department to do statistical auditing, right, just to make sure that everything was working the way it is. I'm going to tell you the CRA is moving away from that, and not in any kind of official capacity, but what you do see and what any of the tax professional out there can tell you is we are adding assessment agents. And I'm going to put this out there, after the financial impact of the plague, the interest by the CRA in collecting taxes legitimately owed could be, this is speculating on my part, could be somewhat elevated over the next few years. So I feel this is a timely time to be having this conversation. So let's not think too much about what we might have got away with in the past. Let's not think too much about what our friends in the Breakfast Club are currently getting away with. Let's consider that it's just a fact that we are in Canada slowly but surely moving to more of a policing stance. You know, to be honest, most likely because of the number of people who are choosing to self-assess themselves in less than fully honest ways. All right. The next advantage of being on payroll would be, you know, maybe you started this company when you're very young and you've been 3 or 4 years now, and you're a couple again, like we talked about, and maybe we become pregnant, and maybe that makes us think, geez, we'd like to buy a house. Well, here's the thing: if you've been paying yourself through payroll, everything's going to be okay. But if you've been paying yourself strictly through dividends, mortgage companies do not like that. Now, it is possible at that time to come in to a provider like us, or your provider, or even yourself, that we're a self-assessed tax nation. You can do everything I talk about, you can do yourself if you want to, and if you take the time to learn how. Okay, so you could then go in at that time and see somebody and have them, you know, go as far back as they can and put in tax adjustments for you and re-tax yourself all the way back as a wage earner, catch everything back up, submit that to the bank, and be good that way. That we could make that case for you. That is an understandable case, that these people didn't realize the consequences when they decided to be dividend paid only. They now realize that they needed to be, they do want to buy a mortgage, they do need to have this. There's other things that are tied into whether you're the wage earning or not as well, not just the mortgage. Mortgage is the big one that catches most people. But be aware of this: if you've got the idea that you're gonna come in and pay us to redo your taxes all the way back and make you a wage earner, then you're going to get your mortgage, then you're going to come in and pay us to put it all the way back the other way, I want to draw your attention to the General Anti-Avoidance Rules, Section 245. I'm not going to read through this. I'm showing it to you so that you can go take a look at it yourself. But the gist of how it would apply to what we're talking about here is the CRA is going to see that. They're going to see it right away. And it's not like it was like in your dad's day anymore. The CRA has powerful AI assistants in their computer banks. And some of this stuff that might be easy to slip by a human eye will never, ever, not even the slightest chance, slip by a computer eye. So be aware of that. You can't just keep going back and forth. We have rules in Canada for it. You can actually assess year on year whether you would like to pay yourself as a wage earner or pay yourself as a dividend earner year on year by drawing it up, like I said, and showing both tax pictures and picking one, keeping in mind the caution that I mentioned earlier. If this is a shareholder loan reconciliation, which mostly that's what we're talking about here, there's a very good chance that in an assessment you will be deemed to be drawing wages anyway. So be cautious of that, and make sure that if you have a bookkeeper or somebody that's taking you down this path, that they also understand this, that they understand the risks that are here, and they're going to be beside you as you know, things come to pass. So, if we look at the other side of things, what about if we just pay ourselves as dividends? Well, one thing is, we're not really going to be at risk month on month of these payroll remittance penalties. And, I'm kind of two minds on that. I get why that would be a relief for people, but we are also talking about people who are company owners. You own a company. You're trying to run a legitimate, profitable company, and I'm just going to go out there and suggest that paying your bills on time is actually part of being a successful, legitimate, profitable company. So on one hand, if you don't enter into the payroll system, then you're not going to have those month on month, potential remittance penalties. However, as I mentioned when we were talking about the T4 side in the first place, you are actually subject to those same levels of penalties paying yourself through dividends based on your quarterly assessment that you were supposed to start remitting. Okay, so the assumption is that sooner or later everybody gets caught anyway, right? So it's important to understand that if you get caught on these kind of things, they're allowed to go back. So it's not, oh, well, I got caught, but I got away with it for 5 years. It's I got caught, and now I have to back pay everything I got away with for 5 years. So this can be company destroying, right? If you've been doing it for a long time and then suddenly you get caught. Here's some other things that you need to understand. If you choose to pay yourself by dividends, dividends are paid after tax. Okay, so in that case, you will pay your corporate taxes, and then you will pay dividends. And that is the reason why dividends have if they're deemed to be actual dividends, have a somewhat more attractive tax picture, can have on the personal side. But again, let's go back to the integration principles. There's only you and your corporation, right? Like, in the eyes of the law, that's two separate things. Your corporation is a person and you're a person. But, let's be real here. There's only you and your corporation. You pay it here, you pay it there. Anyway, you're paying dividends after you pay your corporate tax. And then that gives you perhaps a slightly lower personal tax rate. You'd have to do the total tax picture for you and your corporation to see which way, whether there was a slight difference one way or another. The differences, though, take it from people that have done this over and over again, the differences, particularly since the new integration rules came into effect, are very, very small. And, even being a person who could profit off you wanting to get 2 sets of taxes done every year, year in and year out, I do not believe that you'll make money on that. I believe the amount you'll be paying us will exceed the amount of money you will make doing it that way. That's how I think it would work out. The other thing you need to know, if you're paying yourself solely by dividends, is some of the tax credits available to you and your family on your T1 filing are not applicable to dividend earnings. In fact, there are credits that are only applicable to payroll earnings, is what it boils down to, and so you'll lose those, right? You won't be able to claim those either. That might be a small thing to you, it might be a big thing to you. I've got a list of things I wanted to cover off here. So the long and the short of it is, if your only reason for paying yourself in dividends is because you very much want to be not part of the CPP index pension system and not part of the EI wage protection system, that your stance is you're on your own and you'll look after yourself, that's okay. That's a legitimate stance. Understand that after a period of time that becomes not reversible. Like, you can't get 40 years paid into your CPP if you realize that you wish you'd have done that at 70 years old. So the other thing to understand, regardless of what you're hearing, what you've heard, what you currently believe, the principle of tax integration, which has always been a part of the Canadian tax picture and has been greatly cleaned up since 2018, means that there are not anywhere near as big a differences, tax saving differences, as people suggest there are. The differences are very small year on year. As I said, they're not likely even worth investigating on a year-on-year basis, because of the money it would cost you to know one way or the other. And the third thing that we want to keep in mind is that these dividends that are a part of reconciling our shareholders' loan may not, in the eyes of the government, the overall guidance document says they will be seen as wages, not as investment income, i.e. not as true dividends, i.e. not subject to the dividend tax credit, which would then mean that you're not getting that dividend taxation advantage in your personal taxes either, and you've already paid corporate tax because this has to be paid after taxes. The other side of that thing is, if you're paying yourself salary, then salary is paid prior to corporate tax. So again, it's back to that integration principle. You see, we're just moving the money back and forth across the line, and I'm not saying it won't make differences. It makes some differences at certain times, but every move you make that has some level of benefit has also some level of consequence. So my point in bringing this whole salary versus dividends topic up was, as I said at the top, mostly my concern for making sure that particularly young people who are choosing currently to opt out of the CPP program, I just want to make sure that they understand what they're doing. And I also want to make sure that if you have a bookkeeper that's come to you and said, oh, look how much money I'm saving, all tax money I'm saving you, make sure you understand what they're actually showing you. Because they probably aren't saving you a whole bunch of tax money. Again, back to the principles of integration, tax integration principles, which are part of the Canadian tax, environment. The money that they're talking about is most likely your CPP and EI, which, as a private corporation like ourselves, you owe both the employee section and the employer section, because you are both the employer and the employee. Okay, but that's not a tax saving, right? That is choosing not to be a part of an insurance and pension program. And maybe you're choosing not to be a part of it because you've got a buddy that sells these programs for, somebody or other, and you'd rather buy your program from him. And maybe you're aware that his program isn't going to be as cost effective as the Canadian program, but you know what? You really like this person, or you just really hate government. Either way, they're both legitimate reasons for making the decision. Our only concern at MCR Accounting is that people fully understand the decision they're making. All the way back to the beginning of the video. There's clients in the portfolio, in everybody's portfolio, who have made that decision to skip out of the CPP, and it hasn't worked out for them. In an earlier financial literacy video on RSPs, I believed I advised that young people in certain circumstances, when it comes to these types of issues, you should bet against yourself, if that's how you want to look at it. You know, yes, maybe your plan is, I'm going to be Jeff Bezos rich way before I hit 50 anyway. So I don't care about any of this stuff. Right now, I want that a couple $100 extra a month in my pocket, and it's not going to matter to me when I'm 72. And that's awesome if that turns out to be true. But I know how optimistic I was when I was 25. And I see the consequences in other people's files who were very optimistic when they were 25. And I see the difference it makes when people apply that level of caution to their optimism. Because maybe you're 75 years old and the Jeff Bezos plan didn't work out for you. And wouldn't it be nice to have an index pension? Or maybe you just caught the long COVID and you're not going to be able to work for 6 months. Wouldn't it be nice to be a part of a wage protection plan? Because, you know, we have had clients in the past where we've gone out desperately trying to seek ways for them to have some form of income when these kind of unfortunate things have come into their life. And over again, it comes up to, did you participate in the program? We don't have a mechanism for opting people into programs they chose to opt out of due to unexpected hardship. All these things are unexpected. That's why we call it income insurance. That's why we have indexing in pension plans. All of these things are unexpected. So unexpectedness doesn't have a social program to cover it. And social programs only cover very minimal things. So that's what I wanted to say. I know this is probably a bit long. I have a lot of concerns for the people that are doing this, as long as they understand why they're doing it, and as long as they're taking the proper precautions, that's great. My bigger concern is if you're just hearing it from the people you look up to in your life, or other people that you feel must know more than you because they're older than you or wiser than you or been doing it longer than you, please, please, please do your due diligence. Make sure you know what you're opting out of when you decide to go down one of these paths. Have a nice day. This is MCR Accounting.